Hey guys, Elite Equity here, and today we're going to talk about Jerome Powell's interest rate hike. So as we can see today, 75 basis point hike for Jerome Powell. What that essentially means is 0.75%, right? So 0.75% hike. Oh my gosh, 6% hike. So what do I think is the implications of this, right? So let's look at the implications now. So first thing we can tell, quantitative tightening is going on, which is QT, right? So quantitative tightening is really going strong, and just it shows the market's not in a good place, right? So as basically the interest rates hike and stuff, you're basically getting the cost of borrowing is becoming more expensive and stuff. So you know, now, like, let's say companies in the public markets, the equity markets, let's say they want to finance for like a new building. Let's say if it's a like SPG, Simon Property Group, that does malls and stuff, they want to finance for a new building. Now the rates are increasing, so the cost of borrowing is getting is going higher. So to get like good debt is going to be more difficult, and more like a lot of companies are going to be strayed away from it. So that's really bad. That's really bad for the public equities, and also like this is a time where you need cash. Like a lot of companies need cash to survive, and which is crazy because inflation is still so high. So even if you have cash, you're actually getting burnt out. This is the way I think of it. So like 2020, right? What did we exactly have? We had the opposite of quantitative tightening, which is quantitative easing, right? So that's QE. And when we have quantitative easing, it's usually due to like economic indicators such as, let's say there's a big black swan event like COVID happened, and the whole world was in shutdown, so public equity, everything tanked, right? So then the Federal Reserve steps in and does everything in its power to really like save the economy, the markets, make sure everyone's okay, and stuff like that. So they literally lowered rates to like, I remember like below 2% for mortgages. It was even going below zero. Like they were literally like they were making it as easy as possible for us. So like the cost of borrowing is easy. Companies could survive. They can thrive. The public equities was going up. A lot of people were buying houses. That's why it's through the roof. House prices went through the roof from 2020 to 2022, literally. So seeing stuff like that, it was just they were kind of like helping us as much as they can, but now they're doing QT, like we mentioned, quantitative tightening, and that really shows, like, I really believe when you had QE, what did stocks do? Stocks technically went up. They helped us as much as they can. The Federal Reserve, aka Jerome Powell, was, on our side. They were on our side, so when they're on our side, they'll do anything possible to help us. So that means the public equity market, stocks go up, house prices go up, risky assets such as crypto goes up as well. So you're getting things going up. The Federal Reserve is by our side. They're literally lowering rates, doing as much as they can to help us. They were even buying treasury securities at the time, I believe like 250 billion a month or something like that. What we're going through right now, they're actually selling treasury. They're selling, treasury securities. They're raising rates, and they're thinking of actually, like, raising rates, for the foreseeable future in the next, 3 to 6 months. They're thinking of another 75 basis point hike in November, possibly even 100 basis point by the end of this year. So we're gonna go up, which essentially means the housing market is gonna stabilize and aka kind of correct. There's gonna be a big correction in the housing market. I truly believe that. Like, just think about it, 2020, we had rates so low, so people were buying houses in such good prices, new home buyers, and also like the people who had homes already had equity in their house. Their equity would just kept going up. They refinanced to a lower mortgage rate, a 30-year fixed rate, so they were doing really well. So I believe this correction was needed. We had like literally rates close to like 2 for so long. Like the last recession I remember was like 2008, and I was super young for that. But I just doing my research and studies, this was kind of needed. It was coming. We kicked the inflation rates to the curb. Now it's coming all at once, and I believe when quantitative tightening happens, stocks go down, houses go down. And Federal Reserve, like when they're on their side, they go all in, right? They'll make rates low and they'll be on your side. But when they're not on your side, guess what? They're gonna go all in on the opposite side now. They're gonna be against us. They want unemployment to go up to tame inflation. You know, they literally want rates to go up as much as they can. They'll like do it to the max, to the point where it's, you know, inflation could stabilize. But I do believe, let's look at it from a macro sense. You know, rates are not going to rise forever, right? So it's not gonna rise forever. I believe, like personally, that 2023 will be a volatile year once again. I believe like the first half of you know, 2023 will be really volatile. I think the public equities will, you know, trade in a range from 350 to 400, just bounce here and there. But then again, the markets might have priced in all of this. Obviously, no one knows. The markets might have priced this in, that, you know, this is what's going to happen. But I truly believe in this next 6 months, it's going to be a crucial time. SPY is going to hit, I believe, SPY 350. That's my price target by end of year. And then by first half of 2023, I think it's just going to be volatile. First half of 2020, like I'm saving up cash right now. Cash is king for me right now. Only because I think there's going to be a housing market correction. And when the correction happens in the first half of 2023 to even the second half, I'm going to go buy. I'm going to buy. And then just as soon as the Federal Reserve pivots and they try to lower rates because they realize, oh my God, we're in a recession, they're on our side again. As soon as they pivot, boom, I'm going to lock in a deal. And guess what? Wait a year, refinance and a low mortgage rate. I really am bullish for stocks, specifically 2024. I really think it's a bullish year for stocks then. And also crypto, because, you know, BTC halving is happening. And we all know when that halving happens, it tends to do really well. So, you know, I'm bullish on Bitcoin, Ethereum. You know, I believe right now is a time to DCA into SPY, Bitcoin, and ETH. Those are the three best positions you could, you know, dollar cost average into in the next, you know, let's say like 3 to 8 months. Because first half of 2023, until first half of 2023 is going to be really bad. We're probably going to be, I mean, we're in a recession. Technically 2 consecutive quarters of negative GDP is a recession. And we're feeling the, you know, recessionary times right now. Rates are increasing. We're going to have a housing market correction, essentially, considering how fast we went up. And then stock markets, I feel like public equity is going to be really volatile. You know, we've already like 20% year to date. We're 20% down from all-time highs. So, you know, I'll save up cash, and like also while dollar cost averaging into SPY, Bitcoin, Ethereum, save some cash for like a housing market correction. So next year you could get a nice deal, refinance in like 2024 when the rates are starting to go down again. 2025, I think rates are going to be back at like 2-3%. And yeah, so, you know, be careful out there. What Jerome Powell did was unprecedented. You know, things like that happen. It just literally market cycles. You know, this happens every 10 to 12 years. And, you know, educate yourself, you know, for the next time this ever happens. If the Fed is on our side, go all in public equities and housing, and because rates are so low. And if they're starting to pivot, that's when, you know, sell. If they're saying anything about hikes, sell. Like, sell all your public equities, or, I mean, if you're long, it's fine. If you're 10, 20, 30, 50 years out, depending on your age and stuff. So that's when you know it's a really good time to sell, when the pivot happens and they're, you know, interest rate hikes and, you know, recessionary times, it's looming. It usually tends to happen. So yeah, so, you know, hope you guys stay safe out there. Ali Equity out.